It's almost 1 p.m. in Sydney and 11 a.m. in Hong Kong. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. A subdued mood in stock and futures markets, with Japan's topics leading modest gains. The yen slightly firmer after 4 sessions of declines. Also ahead, Cathay Pacific forced to cancel flights for inspections of its Airbus A350 fleet over issues with Rolls-Royce engines. Plus, the CEO of Taiwanese chip material maker Global Wafers discusses expansion plans amid the tech tussle between China and the US. First up, though, let's take a look at how markets are doing this Tuesday in the Asia-Pacific. Avril Hong's in Singapore. Avril.
Yeah, Paul, as you say, it is quite a subdued mood as we await these U.S. markets to reopen after the long weekend. So volumes are a bit lower than are typical this time in the session. But Japan, as you mentioned, is the outperformer. We're seeing gains among the financial-related stocks, including insurers, amid slightly higher yields. In South Korea, we're seeing the benchmark there flat, but the Korean won is among the currencies that are the worst performing against the greenback today. We got a CPI print which showed that deceleration was more than expected towards the BOK's 2% target. So there are those that think we could see it easing, that pivot coming as soon as next month. Of course, China has been in focus in the past 2 sessions amid this macroeconomic weakness that really came through from the data that we got on the manufacturing front over the weekend. CSI 300 yesterday saw its worst decline in about a month. A bit of recouping of those declines from yesterday on the Shanghai Com extension of those losses, as well as on the Hang Seng flip the board, because we are almost all the way through on the CSI 300 in terms of the reporting. And in terms of some of these aggregate result surprises, we've certainly seen more misses than beats. And on these benchmarks, the CSI 300 and Shanghai Com, for example, we're still seeing them hovering near those 6-month lows. Beijing 50 indices, record low. So certainly a lot to unpack here when it comes to Chinese equities. Let's bring in our next guest, Lorraine Tan, Director of Asia Equity Research at Morningstar. Lorraine, we are almost done with the reporting season on the CSI 300 at least. There is a lot of weakness that's coming through. I think you have been a bit less bearish than most on the Chinese equity space. What's your take on what we've seen this earnings season so far?
Yeah, what we've seen is actually numbers that generally, I think, have been mixed. In some cases, I would say they're clear misses in a couple of cases, but it's mainly been the guidance that's been disappointing more so than the actual June half performance. So on that note, yes, I think some of the share price falls on the guidance grounds is, anticipated or, not surprising. But we do feel that on valuation side, because the numbers that we're looking at may not have changed that much. There's still obviously, the values are still there. It's still going to be aspects on concerns over growth, the concerns over geopolitics is still going to weigh in terms of investor appetite.
Lorraine, to your point about valuations, I think one of our colleagues, a contributor on the MLive blog, pointed out that when you look at some of these aggregate result misses, they've actually climbed increasingly in the past 3 quarters, which gives you a sense of the margin of error when valuing these companies. Do you think enough has been sort of priced in when you look at these valuations?
I think if you look through the short-term cycle, yes. If you're still, we're anticipating that there will be a macro recovery. We're looking at things beyond the current recession, going back to what we would assume to be more normal levels of activity. If you look at it that way, yes, I think the currently bad news is reflected. For example, you're talking about pretty decent companies, let's say on the real estate side, even like Coley, trading it at 0.2 times price to book. So there is a lot of bad news that's reflected on that sense. But the problem is obviously the timing of when that recovery is going to take place. So that's a key uncertainty there. There are certain areas that, for example, on the EV space where we've seen margins compressed due to the fact that there is a lot of competition and intense competition competition at the moment. Now, we do anticipate that that will soften gradually because of scale benefits to some of the EV makers, but there's been an offsetting on that because of the pricing weakness. So that's been disappointing, but it doesn't really change our longer-term view in that sense.
Lorraine, you did mention in that answer there the question over when that recovery is going to take place. I guess that's the critical point, isn't it? It might be a good time to get long, but how long could you potentially be waiting? And is there a risk that things continue to get worse in China before they get better?
Yeah, well, the thing is that from the way we look at it, our base case at the moment, when we look at the measures that are coming through to the real estate space in terms of the absorption and inventory, the pickup, obviously the implementation has been slower than expected, but we still do think that the market, the supply demand should start to balance out probably sometime in 2025. So, middle of the year, we think there will be some impetus for prices to stabilize, and I think that would be a key turning point for us in terms of market confidence, in terms of consumer confidence in particular as well. The good news that we're seeing in some of the mixed results is that, for example, on the restaurant, feedback from restaurants, feedback from some of the consumer defensive names is that we have actually seen the lower tier cities, population, the consumers from that end start to continue their upgrades in their consumption. So more so the continuation of a premiumization. They're still going out, although obviously the restaurants have discounted a bit more. But the weakness is really coming from the tier one space. So the good news is that if you want to look at things on a positive note, the consumption is not falling off a cliff. Definitely the lower tier cities are still seeing that premiumization trend intact.
You mentioned also a moment ago about the need to be selective. Can you maybe walk us through some of your picks in China? What do you like there?
Well, we're still going to be at the first and foremost, I think at this point in time, we've seen the dividend yield plays do well. We've seen, obviously, the financials outperform, utilities outperform since the beginning of the year. Given the sense that we're looking at the lower tier consumers kind of being more stable, one of the topics that we currently like is Agricultural Bank of China, and its interim results actually surprised in terms of net interest margins. So that's nice. So we're now focused more on companies that are able to sustain, obviously, attractive dividends, and also we're still focused on the consumer side of the story. Another example is, we had decent results from Tencent, for example, all pretty broad-based improvement in its activities. So that's also a positive signal. So we're not, I think you have to be selective to see which companies have basically adjusted to the weaknesses in the current cycle, and obviously should benefit as recovery comes through.
It's becoming increasingly difficult to be selective on these Chinese equities, though, Lorraine. I'm just wondering, when you look at picking out the winners amid this smaller pie that we're seeing in China, how are you kind of discerning in terms of sectors? Perhaps you're looking at, some where there's less competition, because I think the competitive aspect is something that came through on some of these consumer stock earnings as well.
Yeah, so I think first and foremost, we still prefer the names that we rate as wide moat or narrow moat. So basically, these are companies that we think can sustain their competitive advantages. So for example, where you've got very strong network effects like a Tencent, for example, or you've got a low-cost base like one of the state-owned banks. So I think those are the entities that we would focus on, and definitely we're looking at valuation here. So even a stock like a property name, as I mentioned, like Kohli, that's trading on 0.2 times book. The assets are high quality, and so we would differentiate on those sorts of aspects. So yes, unfortunately, a little bit more homework to be done, but I think for China, that's the detail that is required.
Yeah, what are you looking at in terms of the big macro event later this month as well? Of course, we do have a Fed decision. Are you eyeing 25 basis points? It seems the market's pretty convinced there's a cut coming. Or do you think we could see 50? And if so, does that look a little bit too much like panic?
I think the market's built in at least 25 basis points. So definitely, he can't go back on that now. And so we're looking basically at about a 50 basis points cut in the second half of this year, perhaps as much as 75. We do think that the U.S. economy is slowing. We do have a base case for a soft landing still. So we do anticipate fairly aggressive rate cuts in 2025, and that should help keep equity markets or equities participants fairly happy. But I think in essence, 25, you're not going to get that much reaction, I would say.
So would you say that a soft landing in the US is your base case at the moment, or do you see any risks to that?
Yeah, it's definitely still a soft landing case. We're looking at pretty slow growth over the next 4 to 5 quarters, let's say, down to about 1.5% GDP growth in 2025 for the U.S. Obviously, the issue with that is that means basically, when I turn back to China, is that the PMI data is still likely to be weak because we do anticipate basically slow global growth over the next 12 months.
I just want to get viewers across some breaking news at the moment. We've got news out of China that China is going to launch a non-discriminatory probe into Canada's tariffs. This is over the tariffs that Canada announced about a week ago on Chinese-made electric vehicles, aluminium, steel as well, bringing it into line with many Western allies as well. Lorraine, this news just hitting the terminal now that China intends to push back on that. I just wondered if you had any reaction.
I think it was anticipated. The news has been out there. I think when one of the obvious issues with the elections coming up in the U.S. is you're going to get a lot more trade rhetoric and tariff rhetoric that comes out. I think in terms of actual impact to the EV companies, we still see it as being pretty marginal. A lot of them are setting up plants, obviously, closer to their end markets. So, for example, they're setting up in Mexico. So, obviously, if there are tariffs are issued, import duties issued on cars coming out of Mexico into the U.S., then that's something we'll need to worry about. That has been mentioned by one candidate, I think. But the thing is that because the export content for these companies is still relatively small, impact to earnings is still mitigated at this point in time. But obviously, because there is excess capacity, that does impact longer term growth.
All right, Lorraine Tan of Morningstar, thanks so much for joining us. Still to come on Bloomberg Markets Asia, we'll discuss India's demand for infrastructure financing. The Deputy MD of a key government agency is going to join us exclusively later this hour. First, though, Cathay Pacific cancels most of its Hong Kong-Singapore flights for urgent inspections of its Airbus A350 fleet. We'll discuss the impact of that next. This is Bloomberg. We are watching shares of Cathay Pacific today, currently off by about 0.5%. This is as the airline says it's being forced to cancel some flights for precautionary inspections of its entire Airbus A350 fleet. And this is after discovering issues with some Rolls-Royce engines. Bloomberg Intelligence senior analyst Tim Backus joins us now. Tim, give us a sense of what this disruption relates to and how long is it going to last?
So, Paul, it's obviously early days. I think it's difficult to say how long it's going to last. I think it's very important to note that the A350 is one of Cathay's workhorses in terms of its fleet. As we've written this morning, for the month of September, 25% of its global seats are going to be flown on this aircraft. And if you look at the distance involved in terms of the ASK, available seat kilometers, it's up to 44%. So are we talking about just the 24 to 48 flights that are being canceled in the next 48 hours, and then, this is, the engines are inspected, there's no more damage found, and then we go on our way? Or could this be something longer?
Tim, to your point, what kind of financial impact potentially are we expecting for Cathay, even as we watch out for the extent of the disruption for the airline?
So I think there's a couple things I would point out. One is that Cathay is doing quite well in terms of its earnings. We just had the first half results just only a month ago. Quite a high profit historically. I think the second half of the year is actually looking quite strong for them as well. So, it's a duration issue. If this goes on to last a while, then of course we could be talking about it as something that they mention in their results, next March. One thing as well is that I think it was reported earlier that it's the Singapore-Hong Kong flights that are being canceled, for example, today. Those are some of its most important routes in the region in terms of, premium traffic. So Hong Kong-Singapore is not one you'd want to be seen to be, having to cancel. Again, is it only a 2-day sort of impact? The other thing I think I would say in terms of, duration is that when we're talking about engines, we've seen globally with airlines and the engine manufacturers a number of different problems crop up, and some of these have had long-lasting impacts. Now, with regards to this Rolls-Royce Trent XWB, which powers the A350, Cathay is saying that this is the first time anywhere globally that this particular component has failed. I haven't seen what component it is yet, so this could be something new. So that's an X factor here in terms of thinking about, will this be a blip in earnings or not? I think the other thing about Cathay's results this year is that cargo is looking very, very strong. And we've written a piece on this last week, noting that airlines like Cathay Pacific, which are really exposed to cargo, could really get an uplift in the second half of this year with the peak season.
All right, BI, Bloomberg Intelligence Senior Industry Analyst Tim Backus there. Now let's stick with the transport theme. Today's Bloomberg Big Take digs into Volkswagen's historic decision to consider factory closures in Germany for the first time in its 87-year history. Now this is as EU car makers lose ground to Chinese manufacturers in the race to produce electric vehicles. For more on this, let's get to our Asia reporter, Linda Luz. So, Linda, what's led Volkswagen to take this decision?
This historic decision really came after a whole series of negative trends that's been hitting Volkswagen and the wider legacy automaking industry. So obviously now Chinese EV makers have become really competitively globally, and they're expanding into some of these car makers' home territories, like into Europe, where Volkswagen is based. And also you've got just weak car sales in Europe as well. It hasn't returned to the pre-pandemic level. That you've got, other than those, you've also got weak performance in the China market. That's also been caused by factors like economic slowdown, fierce competition with domestic players. Now, China is one of Volkswagen's biggest markets, so with its sales falling in that market, it's also taking a hit to its bottom line. So all of these factors are compounding on Volkswagen to make this really difficult decision to start considering whether they need to close factories in Germany.
Linda, what does the Volkswagen move mean for the legacy car making industry's efforts to transition to EVs?
This move really adds to a whole series of gloomy news we've seen in the past few months. Now, that's so Volkswagen's decision came on the heels of other brands like Ford in the US, brands like Cadillac, Mercedes-Benz. They're rolling back their electrification goals, saying that actually the progress hasn't come as fast as they expected, and now it's not sure if these goals will still be achievable. And some of that is caused by this weakening demand globally. You've had consultancies like J.D. Power lower its EV sales forecast for big markets like the US, slashing an expected 12% growth to 9%. And in the China market, the world's biggest for electric vehicles, although it's still growing, that momentum is slowing as well. Not to mention you've got some really intense price war going on in that market. That's eating into the bottom lines of everyone, including big players like Tesla, BYD, and legacy automakers. So all of this paints a pretty negative outlook for the EV industry.
So what are European car makers doing to address this competitiveness issue? And what's the broader picture for EV demand and capacity in Europe?
So some of the European car makers took this approach of, if you can't beat them, join them. So Volkswagen has teamed up with Chinese EV maker XPeng to hope to get some of their technology know-how shared across the board. And then you've got Stellantis, on the other hand, that has invested into another Chinese EV producer called Leapmotor. So Stellantis plans to take some of those models made by Leapmotor to Europe, whether, through imports or local assembly. And with those moves, they're still in the early stages. We're waiting to see whether those models will become popular in the overseas markets. And over the long term, these European car makers are really struggling over how to catch up to the Chinese EV makers who have this head start advantage with all of these battery technology know-how. They've got really sophisticated in-car infotainment systems that the European car makers have to invest in to really catch up.
Mm-hmm. All right, Bloomberg's Asia transport reporter Linda Liu there. And you can read the full article on VW on today's Big Take. That is available on the terminal and on Bloomberg.com. Plenty more ahead. This is Bloomberg. Let's take a look at some stocks that are moving in the Asia Pacific this Tuesday. Tesla suppliers in China doing pretty well. Liancheng Electronic, one of those, the best performing there, up by about 1.9%. This is after vehicle shipments from Tesla's Shanghai factory rose for a second straight month on a trade-in subsidy boost. Tesla shipping about 86,000, getting on for 87,000 Model 3 sedans and Model Y Sport utility vehicles in August. This is according to preliminary data, and that's up about 3% from a year ago. Iron ore prices are slipping again, and we've got some of the big mining names in Australia feeling it. Fortescue, pure play iron ore company, is off by about 1.3%. There's the iron ore futures in Singapore below $100 a tonne. They're off about 2% today. So Fortescue Metals suffering here in Australia. Rio Tinto, its biggest product is iron ore as well. That's off by 1.25% at the moment. All right, we have plenty more to come. This is Bloomberg. The launch of ChatGPT less than 2 years ago sparked an AI frenzy that fueled talk of a fourth industrial revolution. Silicon Valley names grabbed much of the attention, but perhaps the bigger changes are felt in Taiwan, where businesses and markets have shifted as a result. We've got more from our tech reporter, Annabelle Drillers.
Taiwan is the home of our treasured partners, This is, in fact, where everything NVIDIA does begins.
It's become a linchpin of the global economy. Taiwan's dominance in advanced chips has grown through the AI boom, creating fortunes in the process. Local industry billionaires are 90% richer since the introduction of ChatGPT in November 2022, while stocks in Taipei have surged. Property prices hit a record high in March, with the biggest gains in the city of Hsinchu, the home of semiconductor giant TSMC. That wealth boom is raising fears some will be left behind.
There is a worsening of income distribution across the board, and I don't see any measure to improve this at the current juncture. Parents take the brunt by helping their kids, buying apartments and so on, but it's not sustainable because the next generation won't be able to do this.
Taiwan's government, though, has set ambitious growth goals, seeking a $1 trillion economy by 2028, with GDP per capita set to surpass that of South Korea next year. Annabelle Drulers, Bloomberg News.
As the chip industry faces the prospect of more tit-for-tat trade measures, one major Taiwanese firm says the solution is expansion. Global Wafers is the world's third largest provider of essential materials for making semiconductors. Chairperson and CEO Doris Yu spoke to us about plans for funding from the Biden administration's Signature Chips and Science Act.
$400 million for our two expansions in the U.S. One in Texas, which is for 300 millimeter advanced wafer process. Another one is for our Missouri, our SOI 300 millimeter SOI operation in Missouri State. Both of these two projects together, we got $400 million US dollar. CHIPS Act support from U.S. government. On top of this, we also try to apply AMIC, Advanced Manufacturing Investment Credit from the U.S., which will be around 25%. So that's definitely very helpful for us.
Receiving that funding, though, is contingent on meeting certain milestones, and as I understand, the deals of those milestones or the sort of specifications around them are still being ironed out. So where are you at in those negotiations right now?
We just finalized PMT, the preliminary. Basically, the term sheet we have, both parties have agreed. We are working on the long form negotiation now, so it's not the final long form closing yet. So we're still working on the long form discussion with CHIPS Act office. And
when do you think you'd have the conclusion on that?
I would say that we don't have a schedule, but I think that it's likely that we'll get some good result by end of the year.
End of the year. You are already putting billions of dollars into your investments there.
Yes.
What are you seeing so far in terms of demand for the silicon wafers that are expected to come online?
I think silicon wafer demand definitely will grow in the next several years. Matter of fact, it's growing now, but it's just it's slowly. I'm still very positive for our operation in the U.S. For several reasons. One is that it's more and more. It's not like in the past that customers always rely on Asia fabs. They want to have local supply as well. That's the first reason for resilience reason. And the second reason is that more and more our customer, especially tier 1 customer, they care so much about ESG. So they want to make sure that their wafers carbon footprint is very environment friendly.
How much is this US expansion plan also about avoiding any possible tariff risk?
Yes, I think that's part of the reason as well. I believe that in the U.S., not only U.S. but also some other countries, there will be some special tariff. And if you have the operation locally, so that means that we are a global company. We support customer locally. We can avoid from some potential tariff. That's our expectation.
That's Global Wafers CEO Doris Hsu speaking with Bloomberg's Annabelle Drewlers. Key US allies are getting pulled deeper into Washington's push to blunt China's tech ambitions. South Korea says it wants more incentives to encourage compliance with curbs on chip exports. And Japan's now been warned of severe economic retaliation from China. For more, let's bring in our China correspondent Min Min Lo in Hong Kong. So Min Min, seeing some pushback from these Chinese neighbours when it comes to aligning with the US on chip curbs. What are we hearing?
Yeah, you just heard that Doris Hsu saying that these companies are increasingly hedging against geopolitical risks. And we're hearing that South Korea is now calling for more carrots from the U.S. in order for them to align closely with the U.S. when it comes to these chip curbs. And we know that South Korea has in the past been quite successful in trying to carve out these exemptions. They've done so for SK Hynix and Samsung in the past to continue sending their equipment to their plants in China while they cut off dealing with these entities that have been designated by Washington as national security threats. So they were able to maintain some of that profitability with those exemptions. And now you have the South Korean trade minister saying that, look, they are willing to align with the U.S. when it comes to these economic security issues. But South Korea sells half of its chips to China, so they will need some form of insurance, to minimize some of that impact on South Korean firms. And when it comes to Japan, China is threatening to retaliate with limiting the exports of critical minerals to Japan. And we're hearing that U.S. officials are now in talks with their Japanese counterparts to look at a strategy to try to find alternative sources of critical minerals for Japan. And it looks like U.S. officials are quite confident of assuaging these concerns and maybe coming to some sort of agreement with Japan by the end of this year.
Min, there's also been a buildup of domestic pressure in the U.S. as, they get pushed for the Biden administration. How tough might it get on its U.S. allies then?
Yes, Ariel. Well, look, if you look back to 2022 when the U.S. first announced these sweeping tech curbs, you saw this big spike in sale of equipment from the likes of ASML and Tokyo Electron to China. And that's a sign of Chinese companies stockpiling some of these items in anticipation of further curbs. And obviously later on, Netherlands and Japan had followed up with less restrictive curbs than the U.S. And that led to these pushback from U.S. firms who are saying that they are being disadvantaged when China is able to buy equipment from their competitors, their foreign competitors. So they're calling on the Biden administration to really secure agreements with U.S. allies to match the most restrictive agreements there, the most restrictive curbs, rather, before tightening further rounds of curbs on U.S. firms. And you have legislators even calling for the U.S. administration to use the maximum leverage here, even saying that they're willing to support tariffs on foreign chip makers who are competitors of U.S. chip makers. And looking at the timing of all these negotiations going on, it does look like the Biden administration is trying to lock in as many of these agreements as possible as well before he steps down in January.
Right, pressure on all sides. Great to have your insights, Min Min. Thanks so much, China correspondent Min Min Lo. Let's take a quick look at how chip stocks are faring against that backdrop. Yesterday, we saw the likes of Tokyo Electron and LaserTech declining after that Bloomberg scoop that showed how China is mulling the retaliation if Japan indeed ramps up some of these chip curbs as the U.S. wants. And it's an extension of yesterday's moves. Toyota, another stock that's in focus, the world's largest automaker, saying that it's delaying the resumption of output of some of these suspended models because of a typhoon, and that it will resume things once things stabilize. Taking a look at the broader indices in Japan, we're seeing the financial stocks that are among those that are gaining ground amid higher yields. So that's helping to cap the declines that we're seeing on the topics. The yen is also, of course, in focus given how it's been declining the past 4 sessions. We're going to unpack that with Bloomberg M-Life strategist Mark Cranfield, but as I know, Mark, he's been looking very closely at the JGB auction as well. I mean, what are we seeing in terms of demand? Is there indigestion?
This is the most exciting bond market in the world. This is the only market that can challenge treasuries in the next few months for stirring up the whole G10. Not a great auction. The tail is a big improvement. The auction in August coincided with all the mayhem in Japanese assets. So, of course, it didn't go very well. It was probably the worst auction for 20 years or so. This one is an improvement in terms of the tail is a bit tighter, but the bid cover is well below average, and traders will be looking at that quite closely. So not very happy with what they're seeing so far. JGB futures are trading lower. And the problem is it's not just 10 years this week. We have a 30-year auction to come in a couple of days as well. That's a lot of bonds for traders to digest when yields have come down quite a way already. So we're looking at, on the 10-year, below 1%. A lot of people were interested in buying it was 1.1, somewhere around there. Down at these levels, it's going to be very hard to justify holding on to these kind of bonds. And the reaction, yeah, not that good so far.
So what are you looking at in terms of, longer term when we look at how investable these Japan bonds are?
We're going to have to wait a little bit longer. There's Bloomberg Economics have a very nice piece out today detailing how, when you look at the inflation data in Japan, we had the Tokyo CPI last week, which was hotter than expected. And if you look at the breakdown in general, if you go deep into the inflation data, what it's showing is it's actually creeping up probably faster than the Bank of Japan is even acknowledging. And that really gives them the confidence to go ahead and tighten policy. We saw Mr. Ueda, when he was in Parliament recently, he reinforced the view that there's more tightening to be done. He's not going to be dissuaded. The data is very much in his favor. There's going to be more CPI data to come from the national figures later this month. But even if September is on hold, which was never going to be a big surprise, no one really expected a rate change this month. But October really is looking like the case when the Bank of Japan can move. And if you look at the way the market is priced, it is not expecting a 25 basis points hike. It's looking that the Bank of Japan would do something. The first two moves have been 10 basis points, then 15 basis points. The market thinks they're going to stay with something like that. But if you look at what the G10 world does, and if you look at what Bloomberg Economics is projecting, 25 basis points is a more likely scenario. So market's not ready for it. They don't. We're going to get volatility. If we get volatility in Japanese bonds, it will spread across the whole G10 complex.
And the yen?
Yen is going to do better than David Finnerty thinks.
What do you think about, when we look at the jobs report on Friday, is it going to be really win-win for the Japanese currency?
Yeah, I think you have to look at it from the point of view of what's priced in terms of the dollar market in the rates curve, and think of what's happening on the Bank of Japan side as well. So we go into the data. We're expecting not a huge change. The big one is the unemployment rate itself. Last was 4.3. Projections are it will be pretty close to that. So that will seal the deal for the Fed only moving 25 basis points. Now, the US equity market might not take that so well because they're probably looking for a faster pace of cuts, might give a bit of an abrupt move in the market. They're a little bit risk off. If the whole market space goes a little bit defensive, that probably suits the yen. It becomes a bit of a haven again. On the flip side, if we get a really bad employment report and people start thinking that 50 basis points is back on the table from the Fed, that's just bad for the dollar across the board. The dollar will be sold off aggressively, and most likely the yen will be one of the leading currencies. So from my point of view, it looks as though dollar yen is in for a reasonably bad week, either a slight downward move or a big downward move. Mr. Finnerty sees the seasonals. He thinks that dollar yen tends to go up in September. It's a reasonable argument. Let's see who comes out right at the end of the week.
I can't wait to see who comes out right. But, talking about flipping, the other thing that you've been watching out for this week also is the potential disinversion of the U.S. Treasuries curve. Why, and what does this tell us about, broader trends?
It's almost coming to an end anyway. We're just down to a couple of basis points now. Again, once people see the employment report and they're pretty confident the way the Fed is going to go, typically when a central bank starts to lower interest rates, you see the curve flip back to a positive stance if it was inverted beforehand, because the pressure comes on the lower end of the curve compared to the long end. But this time around, it could flip around for a while. We may go back to a positive curve for a short term and then go back the other way as people start to go a bit risk averse. Eventually, as the Fed gets into its cycle, maybe by the second, third interest rate cut, you would expect that the positive curve will stay in place and be that way for an extended period. But we're likely to chop around for a while, particularly if people start to think that the Fed is not doing enough or is not fast enough, because then they will think that the hard landing scenario could still happen. In which case they'll push themselves to the long end of the curve and they'll push the 10-year back down again. But we're unlikely to see the ridiculous inversion that we saw of 100 basis points. That's not coming back.
There's a lot to digest, Mark. I'm so glad that you're here to help us along with it. Bloomberg M9 strategist Mark Cranfield, great to have you with us. Thank you so much. Paul.
Still to come, we're going to discuss demand for infrastructure financing in India. The Deputy MD of India's largest lender for the sector is going to join us exclusively next. This is Bloomberg. Let's check India markets. We're about 1 minute into the open here, and there's not a lot to write home about. It's a pretty quiet day around the region more broadly, actually. The Sensex flat there. The Nifty 100 just better by a couple of points. And we are, of course, keeping an eye on that index because it's put in a pretty impressive run over the past 2 weeks. India's national infrastructure pipeline is aiming to complete almost 7,000 projects by next year. It's got a targeted investment of more than $1 trillion. One of the government's key arms in funding its mammoth infrastructure needs is the National Bank for Financing Infrastructure and Development. Joining us exclusively now is the bank's Deputy Managing Director, Samuel Joseph Jabarish. Samuel, thanks so much for your time today. I'm just wondering, how much can you give us a sense that you're planning to lend to India's infrastructure sector, not just in this year, but in next year as well?
Hello, Paul. As you are aware, we are a very new development financial institution set up exclusively for financing infrastructure. We are just 20 months old. And in this 20 months, we have assessed over 200 projects worth loans aggregating rupees 2 trillion. That is about USD 24 billion. And we have, this year alone, we plan to sanction about USD 12 billion. And in the next year, about USD 14.5 billion. We propose to disburse about USD 7 billion this year and USD 10 billion next year, all in rupee terms, of course, because most of these projects are infra and they borrow in rupees. And these exposures are spread across various sectors like roads, power including renewable energy, ports, telecom, city gas distribution, education, hospitals, logistics, warehouse, etc. Almost all the infrastructure segments.
So how do you differ from regular banks when it comes to infrastructure lending?
Yeah, most of the other commercial banks also do infrastructure lending in our country, but the value that we bring to the table is on the tenor, on the structuring, and on fixed interest rates. Meaning a commercial bank will be able to fit the solution that they have with the requirements of the client. But we, being a development financial institution, can tailor our solutions to meet the requirements of the company and do complex structuring. For instance, recently we had done a pretty large transaction, over USD 750 million worth transaction. This was a 25 SPV structure with pooled cash flows, a restricted group financing, so on and so forth. So our specialty comes in structuring complex transactions in the infrastructure space. The second one is on the tenor. These concession agreements are typically 25 years, or some of them are even longer than that. So if we have to finance them with a reasonable tail period, then we need to give really long-term financing. Commercial banks do this with put-call options in between, but we can do without the put-call options and really do long-term. The other value that we bring to the table is on the fixed interest rates, where infrastructure ideally should move to the bond market, or at least should borrow with fixed interest rates and should not take interest rate risk. We are in a position to offer that as well to the infrastructure players.
Samuel, can you help us understand how big a financing gap there is in India and how, you're working to fill the gap?
Yeah. See, if India has to become a big 5 trillion economy, 10 trillion, or USD 35 trillion economy by 2047, which is the target set for the country, then spending on infra is a given. I don't think we can do away without spending on infra. So the next 2 decades or 3 decades are going to be a very large infra play for the country. As of now, we spend about 3.4% of our GDP on infra. This has to be necessarily increased to 5 or 6% of our GDP going forward. So there is a huge requirement for infra financing, and there is a lot of traction almost on all sectors of infra, whether it is roads or whether it is power mainly on renewable energy side, both from the government side because of its commitments internationally, and also from the commercial side. Especially today, we see a lot of action on because of the CBAM having kicked in the EU and UK. A lot of exporters, especially steel, aluminium, cement, fertilizers, all of them are switching over from conventional energy to renewable energy, and hence there is a huge demand. As we speak this year, the target for implementation of renewable energy projects is 50 gigawatts. So this is a very huge opportunity for people like us to fund renewable energy, and we are very actively participating in funding this requirement.
Samuel, I just wonder as well, how might the interest rate environment affect infrastructure financing? How are you looking at things?
Ideally, interest rate risk should not be taken by these projects. And as I said, we are pushing or educating them to borrow a fixed term. And we are in a position to lend fixed term because we also borrow in the bond market, and all our liabilities are fixed as of now. In fact, we have raised bonds worth 28,000 crore in the last 14 months. We started our borrowing operations only in June last year, and in the last 14 months, we have done about 28,000 crore. That is USD 3.4 billion equivalent. These are all in the 10, 15, and 20-year formats, and we borrow fixed INR listed bonds. And hence, we have also, it makes sense for us to also lend fixed rates, which is also the requirement of the infrastructure players, because they don't have a hedge against inflation. The PPAs, the power purchase agreements that they sign are typically fixed in nature. At least in the road concession projects, there is a certain element of inflation pass-through. But in many other concessions, it is a fixed revenue stream which they have. And hence, we have been educating our borrowers that they should be borrowing fixed term, and some of them are seeing sense or seeing value in it, though many of the others are seeing that we are at the peak of the interest rate cycle, interest rate will go down, and why should I lock in at a higher rate? But our education to the customer is that in a 15-20 year loan period, there will be 3 or 4 cycles, and this will all get evened out, and hence we are educating them to borrow fixed rates as a risk mitigant for these infrastructure projects. I think slowly some of these people are borrowing fixed long-term rates.
Mm-hmm. All right, Samuel Joseph for National Bank of Financing, Infrastructure and Development. Thanks so much for joining us today. We have plenty more ahead. This is Bloomberg. Let's take a look at what's going on in foreign exchange markets at the moment. Seeing a lot of weakness for pretty much every G10 currency, with the exception of the yen. The yen, the only G10 foreign currency stronger against the greenback today, although that's not saying much. It's still only at 146.48 at the moment. Got the Aussie dollar sliding as well. Got a lot to do with what's happening with the iron ore price there. Iron ore slipping below $100 a tonne. Quite a bit of weakness in the Aussie right now. 67.45 against the greenback right now. All right, that is it from Bloomberg Markets Asia, Horizons, Middle East and Africa. Up next, this is Bloomberg.